Hi friends, today we will go through some of the basic principles of accounting and how the principles of accounting can help you in preparation for various examinations as well as to clear some of the concepts of accounting. So to start with, for accounting there are a couple of golden rules. So there are three golden rules of accounting. The first golden rule is to describe first of all the nature of the accounts. So the accounts are three types: personal account, real accounts and nominal accounts. Personal accounts are those accounts which are belonging to a person or a particular enterprise or particular individual. Real account is an account which belongs to the category like cash, trade, inventory, fixed assets, basically something which you can feel or for which you can have economical value in a tangible manner. The third account is nominal accounts, which are typically like incomes and expenses, which do not have any real live value, but they are in the nature of accounting transactions, in the nature of income and expenditures. So the golden rules basically says three concepts for the three individual account categories. So if you look at it, the rules are around debit and credit. So anything which has a debit has an equal and opposite credit. That's the fundamental principle for accounting. So if it is a personal account, the rule is debit the receiver, credit the payer. So if Mr. A is paying to Mr. B, Mr. A is the payer and Mr. B is the receiver. So in the books of Mr. A, the accounting would be Mr. B, who has paid to him, would be credited. As we said, credit the payer and debit the receiver. And in the books of Mr. A, the accounting would be a credit to Mr. B, and in the books of Mr. B, the accounting would be debit to Mr. A. Now, while we are discussing this, it's quite evident that you need to correlate it with something which is going in or out, right? So what's going in or out is cash or a bank transaction, right? So when a debit happens to a person, the credit normally would happen to a real account. So for real account, the concept is debit what comes in, credit what goes out. So again, going back to my earlier example, if it is Mr. A who is receiving the money from Mr. B, very simple transaction, right? So very evident. So if he's receiving money from Mr. B, then as we said, in case of personal account, credit the giver, right? So the credit the giver in this case is Mr. B. So in Mr. A's books, Mr. B becomes a credit entry, and he's receiving a real account which is cash. For cash, what we have said is debit what comes in, credit what goes out. So obviously he's receiving money from Mr. B, so therefore he's receiving cash, cash being a real account, debit cash account. So that's a very simple concept in Mr. A's books, and vice versa will happen in Mr. B's books, where because cash is going out of his books and it's a real account, cash would be credited and Mr. A's account would be debited, and we normally call it as a debtor in Mr. B's books, and which is Mr. A, and in Mr. A's books it would be a creditor, and Mr. A would be appearing as a creditor. So by this example, I just explained to you, through one transaction I explained to you how an accounting entry can be described in terms of personal and real account. Now imagine you have a business, right? And you are incurring some expenditures for rent. Now rent is something which is neither a real account nor is a personal account, because as we said, a personal account has to be somebody like a person, right? A real account is something which you can feel, it's really tangible, right? So in this case, rent is not tangible, you can't feel it, it's not a real account, nor it's a personal account, because it's not a person's name. So therefore, very clearly, in this case, an expenditure is incurred as a rent, being a nominal account. Nominal account, also some authors or some people call it as fictitious account, but I would just say it simply as nominal accounts. By nature, nominal accounts at the end of a period need to be nullified, right? So they normally move to a P&L, of any enterprise, or in case it's your personal budget, it moves to your own personal budget, and we clear it off at the year end or at the quarter end. So in this case, if you are paying rent, right? And obviously you're paying rent either through an online transaction or through cash account or through, I don't think by kind, right? Roughly you'll pay by cash or through a bank account transaction. So in this case, what's going to happen is rent is an expenditure, right? So as we said, debit all expenses and losses, credit all incomes and gains. So in this case, simple, debit the expense, which is rent. Credit is a question, right? So as I told you, it's a cash account or a bank account or an online transaction through which you're paying. So what's happening is your real account, which is a bank account, is getting reduced. And as we said, going back to the rules, for a real account, anything which goes out is a credit, anything which comes in is a debit. So in this case, the credit is to a cash or a bank account, right? So the accounting entry would be debit, rent, credit, cash or bank, right? So that's how, through this simple analogy, I explained to you how you can do a simple debit and credit transaction. And by this method, you can solve many of the accounting problems. Let us take one more example, right? You have a lot of money and you would like to buy a television, right? And a television typically would be lasting you for at least 2 to 3 years, 4 years, depends. Nowadays, obviously, models and designs change, but sometimes, you would like to at least have it for a year or 2 years time. So typically, it becomes kind of an asset for you, right? So you are using it over a longer period of time. Now I would like to describe at this stage an asset. What's the definition? So sometimes people get confused that, okay, what's an asset and what's a typical expenditure? So an asset is something for which you will get tangible benefits over a period of time, typically more than a year's time, 2 years, something like that. Companies define many times their own criteria of what they can take in as a longer term asset, whether it's 1 year period or 2 year period or maybe even 3 or 4 years. Some cases IT assets are charged over a 5 year period. So in this case, what we need to understand is an asset is something which gives us a longer term value. Now a rent in the earlier example is just a short term value, right? So for a month's time you're incurring a rent expenditure. You're not creating any tangible gains out of it. You're not creating anything which is going to yield a tangible result to you in form of an asset. So we classified it as a nominal account, as an expenditure. But at the same time, if you are buying a television, to my earlier example, and it's you will use it in your office or at your home for a longer period of time, which is typically more than a year, then it becomes an asset, right? And there are multiple examples of an asset. Even a cash is an asset. Your furnitures are an asset. Even for example, you have some machineries which are an asset. But in a business context, an asset, for example, a trade inventory, while it's an asset, but it's not something which is a longer term asset. You would like to liquidate it very soon. So when we talk about assets, and they are typically real accounts, right? So normally, except for debtors are some as we said that which are personal accounts, so they become really name of the person or an individual. But apart from that, most of the assets are real accounts, whether you've got a land, building, furniture, fixtures, your properties, your intellectual rights, your cash, your bank account. So by nature, since assets are real accounts, it's very easy. So whenever you gain an asset, you add to an asset balance, right? And the easiest way to add to an asset balance is to debit that account, right? Remember, debit is a plus transaction, credit is a minus transaction, right? So you're debiting an asset account, and the moment you debit an asset account, it increases the value of the asset. So going back to the real account concept and linking it to the assets. So if you see a real account and an asset, so for example, you have purchased a machinery over a period of say 4 years or 5 years, you'll be using it. So your machinery account again becomes debit, right? And since you are paying it through your bank transaction, your bank account becomes a credit. Now you may not pay directly immediately. You may be taking a loan from a financial institution. The moment you take a loan from a financial institution, remember we said a personal account is a name of a person, right? So the personal account, what we said was credit the payer, right? Debit the receiver. So in this case, who is paying you or who is giving you that asset? Actually, you're getting it from a financial institution. So most probably you will credit to a financial institution. For example, let's say a local bank, for example, State Bank, right? So you will be crediting State Bank's account, and it's normally called a loan account in your books. So in this case, the debit becomes a machinery, credit becomes the particular loan company or the banking company, which is in our example State Bank. So like this, even I explained to you how a real account and an asset are almost the same, except for, as I gave you one example, was a debtor, where you have people who owe you money, right, which is not a real account, right, which is more like a personal account. So going forward, right, so once you have been able to classify your accounts from your trial balance, now going back, what is the trial balance? Trial balance is nothing but a statement of all your accounts, which will be either a debit or a credit, right? So you get a trial balance. Trial balance normally tallies, right, and under no circumstances we would expect them not to tally, because as we said, a debit has to have an equal and opposite credit, right? So from your accounts, from the trial balance, you will be able to easily make out what are the personal accounts, what are the real accounts, what are the fictitious or nominal accounts, and all nominal accounts, right, need to be posted to the P&L at the end of the period. So whether it's a quarterly closing or a monthly closing or a yearly closing which you do, you'll need to post it to the P&L. The P&L typically would be something which is an accounting statement, where all the nominal accounts go in, and at the end of the day you will be able to define what's your profit and loss. Now that we will take up in a separate chapter, because as of now we are still on the principles of accounting. So as a revision, right, so what I told you is that there are three types of accounts which are there: personal accounts, real accounts, and nominal accounts. The fundamental principles and the golden rules for the accounting are: for a personal account, debit the receiver, credit the payer. For a real account, it is debit what comes in, credit what goes out. For a nominal account, it is debit all expenses and losses, credit all incomes and gains. And what we said was that every debit will have an equal and opposite credit. So you will have to look at each transaction, and each transaction will have a particular personal account or a real account, or it could be a real account or a nominal account, or it could be nominal account or personal account in this combination. It could also be a personal account to a personal account. It could also be a nominal account to a nominal account. It could also be a real account versus real account. So in my further videos I will definitely share more examples of it. This was a video to just introduce the fundamental accounting principles and what is accounting. So keep subscribing to my videos, keep liking it, and I'm happy to keep teaching and explaining the principles of accounting and finance to you. Thank you. Bye.